All right, let's talk about something that really shook the world. In 2008, the global economy went through a massive financial crisis. And even if you didn't follow the news back then, you probably felt it. Banks failed, markets crashed, people lost jobs, homes, and savings. This wasn't just a bad moment in the stock market. This was the financial system almost freezing. Think of the economy like a big machine. Banks are part of what keeps that machine running. When banks stop working properly, everything slows down. And what makes this story so important is how it started. Not with something crazy, not with something complicated, but with something very normal. Buying a house, getting a mortgage, believing that owning a home was safe. Now let's go back to the early 2000s. At that time, house prices in the United States were rising every year. And when something goes up for long enough, people stop questioning it. Many thought, if houses keep going up, buying one is always a good decision. Banks thought the same way. They started giving mortgages more easily, even to people with low credit or unstable income. These were called subprime loans. For many families, this felt like a huge opportunity. People who never thought they'd own a home were suddenly approved. But here's where the problem starts. A lot of these loans were risky. Some had low payments at first, then much higher later. Others didn't properly check income. Now, an important detail. Banks didn't want to wait 30 years to get paid. Instead, they took thousands of these mortgages, bundled them together, and sold them. Imagine putting many home loans into one big box and selling that box. As long as people kept paying their monthly bills, everything looked fine. These boxes had fancy names, like mortgage-backed securities and CDOS. And to make everyone feel safe, rating agencies said, "These are fine. These are safe." They even gave them the highest rating, AAA. So investors all over the world bought them. But the risk didn't disappear. It was just hidden inside the box. Here's the thing about systems like this. They only work if people keep paying. But then interest rates started going up. Monthly mortgage payments became more expensive. Many families couldn't afford them anymore. Missed payments became common. Then foreclosures. Houses started flooding the market. And when too many houses are for sale at once, prices fall. That's when the bubble pops. Those mortgage bundles depended on monthly payments. When payments stopped, the money stopped flowing. Suddenly, those safe investments weren't safe at all. Banks didn't know how big the losses were. And when people don't know how bad things are, they panic. Then came the shock. In 2008, a huge investment bank called Lehman Brothers collapsed. This was a major moment. If a bank like Lehman could fail, people thought, anyone can fail. And fear spread fast. After Lehman collapsed, banks stopped trusting each other. This is extremely important. Banks lend money to each other every day to keep the system moving. When that stops, everything freezes. This is called a credit freeze. Without credit, businesses can't pay workers. Stores can't buy products. People can't get loans. So governments stepped in. In the United States, major housing institutions were rescued. Then came a massive bank bailout called TARP. Hundreds of billions of dollars. Now, a lot of people were angry. And that reaction makes sense. It felt like banks were being saved while regular people suffered. But leaders feared something even worse, a complete economic shutdown. The Federal Reserve also acted. They lowered interest rates to almost zero, and they injected money into the system to keep it alive. Slowly, the panic began to calm. But the damage was already done. And now, let's talk about what really matters. What happened to regular people? When banks stopped lending and companies lost money, businesses began to shut down. Factories closed, stores closed, and millions of people lost their jobs. And here's the hard part. When you lose your job, everything else follows. Without income, people couldn't pay their mortgages. Families were forced out of their homes. Entire neighborhoods were left empty. Savings that took years to build disappeared. Retirement accounts dropped fast, almost overnight. And this didn't stay in the United States. Because the global economy is connected, trade slowed everywhere. Ships stopped moving. Factories around the world felt the impact. This period became known as the Great Recession. And for many families, recovery didn't take months. It took years. After everything that happened, governments had to stop and ask a very basic question. How did we let this get so bad? In the United States, the response was a new law called Dodd-Frank. Its goal was simple: make the financial system safer. It added more rules for banks, more oversight, and more protection for regular consumers. The idea was to stop banks from taking huge risks with other people's money. But here's the honest part. Not everyone agrees it was enough. Some people say the rules helped. Others say they didn't fix the real problem. And that debate is still happening today. The 2008 crisis showed us something important. Finance isn't just numbers on a screen. It affects real people. And understanding what happened helps us avoid repeating the same mistakes.